Between 2012 and 2019, the European Central Bank operated at maximum capacity, yet it completely failed to generate basic economic growth or target inflation. The bank pushed interest rates into negative territory, purchased over 5 trillion euros in government and corporate bonds, and eventually started paying commercial banks to lend money. Economists call this failure the zero lower bound. Imagine an economy as a heavy truck on a steep hill. Normally, a central bank floors the gas pedal by cutting interest rates to zero, but the hill is so steep the truck still rolls backward. When the standard laws of macroeconomics break down, making money completely free loses its power to drive the economic engine forward. The warning signs first appeared in the 1930s, when economist Alvin Hansen identified what he called secular stagnation. The idea gathered dust for 70 years, until former U.S. Treasury Secretary Larry Summers revived it for the modern era in 2013. This diagram shows a gauge representing R star, the economy's Goldilocks rate, the baseline interest rate required to keep the engine perfectly balanced. But slow-moving forces, specifically aging populations and massive global savings, add permanent structural weight, forcing the R-star baseline to plunge into negative territory. If an economy structurally demands a negative interest rate just to function, central banks are effectively trapped. They cannot push their primary lever low enough to restart the machine. During the Eurozone crisis of the 2010s, the region's specific legal blueprints acted as structural guardrails that actively steered the economy into a ditch. Following a massive crash, the private sector entered a balance sheet recession. A balance sheet recession is a severe economic condition where panicked businesses and households entirely stop spending to aggressively pay down their debts, creating a deflationary cycle that speeds up the more they try to save. When the private sector completely stops spending, the national government is the only entity left with the capacity to provide a fiscal blood transfusion and keep the system alive. But the European Union's Stability and Growth Pact legally mandated austerity. It forced member governments to strictly cap their deficits and aggressively cut public spending at the exact moment their economies desperately needed investment. By enforcing strict spending limits during a crisis, the Eurozone's rules actively drained life from its most vulnerable members, engineering a catastrophic collapse in demand. At the same time, Germany, the industrial engine of Europe, operated under labor reforms that suppressed domestic wages, creating a massive surplus of unspent wealth. This diagram illustrates the demographic trap as a bathtub. An aging society with high exports leaves the savings faucet completely open, but with domestic investment blocked, capital pools up, exerting immense downward pressure on interest rates. Within a shared currency union, this dynamic is a zero-sum game. The overflowing surplus from Germany flooded into peripheral nations, forcing internal wage and price levels to compress downward. Because struggling nations like Greece and Spain could not devalue their own currencies to compete with Germany, they were forced into internal devaluation. Internal devaluation is the process of deliberately crushing domestic wages and prices to regain economic competitiveness. Deflation became a designed feature of the system. In the United States, regional crashes are cushioned by automatic stabilizers. Automatic stabilizers are federal mechanisms like unemployment insurance and food stamps that instantly redirect tax dollars to struggling areas without requiring a legislative vote. The Eurozone has no equivalent fiscal union. Without a massive central budget, crashing countries had to absorb the total destructive force of a recession entirely on their own. In 2012, ECB President Mario Draghi promised to do whatever it takes to preserve the euro, using monetary painkillers to compensate for missing structural architecture. But monetary policy cannot replace missing fiscal shock absorbers. The ECB's absolute inability to generate target inflation over the next 8 years became the ultimate validation of the stagnation hypothesis. Then, in 2022, inflation suddenly exploded to 10% across the continent. Critics of the secular stagnation theory argued that this surge proved the sluggish 2010s were just a temporary debt hangover, rather than a permanent structural defect. But proponents of the stagnation camp pointed out that global governments accidentally pumped trillions of dollars in COVID fiscal stimulus into the economy. This was the exact brute force override their theory had always demanded. The sudden inflation spike did not disprove the theory, It proved that only extreme, coordinated government spending can overpower a structurally depressed economy. Fast forward to 2026. The pandemic fiscal stimulus has evaporated, but the deep structural forces of aging populations and savings gluts never went away. This chart shows Eurozone inflation spiking wildly in 2022, before rapidly crashing back down. Today, inflation sits at just 1.7%, and quarterly GDP growth is a microscopic 0.1%. Unless the Eurozone radically redesigns its fundamental architecture to include a true fiscal union and coordinated public investment, the machine is doomed to permanently slide backward down the hill.